Dave Ramsey loves to spend a lot of time bashing on whole life insurance, and I've been pretty bold in my stance that Dave is either flat out lying to people or he's completely naive and ignorant to the facts of how whole life insurance actually works. Now, I happen to believe that he's just too intelligent of a person to actually be unaware of what he's talking about. You know, that aside, the purpose of this video is to go through Dave's perspective on whole life insurance and to set the record straight. So my call to action and my challenge to every single person watching this who follows Dave Ramsey's advice is that I encourage you to hang out, to watch what I have to say, to really open your mind to what I'm going to educate you to on how life insurance, whole life insurance, when it's properly designed, actually works. If you disagree with me, if you think that my case, the evidence that I'm putting forward here on how whole life insurance can fulfill multiple duties in people's lives and can help them solve all sorts of different financial problems when it's done the right way, if you disagree with me, I encourage you to challenge me in the comment section below. Let's have a conversation around this, because I realize it's not for everybody, and I will acknowledge that if it's not done properly, Dave is right in a lot of ways. However, what I'm going to show you is how life insurance can actually, properly designed whole life insurance, I should say, can actually solve multiple problems in your life, and it's actually a great way to leverage your money to perform multiple duties in your life as you go through life. And I always kind of say, Dave speaks from a scarcity mindset, and Dave speaks from a very short-term mindset, actually, when we need to be thinking about long-term goals. And you can't solve long-term goals with short-term thinking. So if you haven't already, make sure you subscribe and hit the bell, that way you're notified every time I launch a new video. Let's get into it. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and this video we're going to be talking about Dave Ramsey, whole life insurance, and ultimately I'm going to go through and talk about these topics on whole life insurance. What I want to do is I'm going to show this. This is what we're going to be covering on where Dave Ramsey is wrong. He talks about life insurance, whole life insurance being compared to an investment when it's a savings, and I'm going to explain that. He talks about how the life insurance company keeps both the cash value and the death benefit. I'm gonna touch on that. He also talks about how it's a ripoff because the life insurance company simply is giving you a return of premium for the dividend. That is what your dividend is, basically saying that you are just getting your own money back. Therefore, they are overcharging you for this, and so therefore it's a ripoff. I'm gonna go through that. And then ultimately at the end, and this is important, I'm gonna talk about the #1 benefit that Dave omits and he never covers, or at least I've never seen a video of him talking about this benefit. And so I believe it's such a strong benefit that he leaves it out intentionally, because if you understood this, you would pretty much turn your back on Dave and realize how powerful this could be in your life. And honestly, I've had so many conversations with a lot of people that were helped by Dave. And so I don't want to sit here and just make this a Dave bashing session. I do want to make it about ultimately opening people's eyes to how Dave Ramsey is wrong about life insurance. But with that said, I don't want to like take this to the level, like, I believe Dave does some good things. I think if you are struggling with debt, I think if you are not good at managing your cash, and that if you're over your head and you don't understand some really, really basic financial principles, then Dave Ramsey's advice could be good for you to at least start the journey. But I think what I've found in a lot of the conversations that I've had with people, and we have a lot of clients who once upon a time believed in the mindset that Dave Ramsey teaches. But what happens is, as you grow, as you develop your skills and abilities and your knowledge and understanding, you typically, especially if you're an entrepreneurial mindseted person, will outgrow Dave Ramsey's advice, because you realize that there's no way you can follow his advice and achieve anything of any great significance in this world. So that is it. So let's just get into this. What I did is I put together an illustration because I wanted to show this illustration as kind of like an apples to apples conversation. And I wanted to I built this, and I want to have this conversation through the lens of, if I were showing it to Dave, what would Dave say to me? What would Dave be being like, no, this is a ripoff because, right? Like, this is bad because, and I want to have that conversation and answer all those questions that I just kind of went over, and then give you the bonus on what makes it even better at the end. So I'm going to share my screen now, and I'm going to get into this. And I think this is going to be really, really good stuff. So what I did here is you can see, I went and you can see we got a 46-year-old. So I basically said, all right, this person is 45, standard non-tobacco. We didn't do anything crazy. We did a standard non-tobacco policy. And so we didn't want to like bump it up and make it look better with like overly preferred ratings or anything of that nature. So that's a good thing. And what we did was I assumed like, all right, I assumed this person was a Dave Ramsey follower, right? And so they had an emergency fund kind of saved up. I assumed that they had $60,000 sitting in a bank account or maybe a CD or some kind of safe money of that nature. And that was that. Now, I'm also assuming that they're affording $1,000 a month or $12,000 a year of deposits going into this account. And you'll explain why after. Now, obviously, if Dave Ramsey heard that you were putting $12,000 a year into a whole life policy, his head would probably explode and it would get really ugly. But what I want to do is I want to challenge you to keep your mind open. I want to challenge you to think about, okay, what if I knew nothing about this, if I'm just seeing this for the first time, let's not think about Chris's opinion at Life 180. Let's not think about Dave's opinion, but let's just hear the objective facts, the objective reality about, you know, how this stuff can actually work in my life. So the first things first, what I want to do is I want to talk about life insurance not being an investment, because Dave always says, why would you put your money into a whole life policy? Because all a whole life policy is trying to be both insurance and an investment at the same time, and it does poorly at both, right? And so I would argue that that is just a statement that he created because it fit his paradigm and it fit his model to sell more of his courses and his advice and coaching and so on and so forth. It is not the case. Life insurance, whole life insurance specifically, and I know this gets confusing because a lot of index universal life agents out there position IUL as an investment alternative to like a 401k alternative or an IRA alternative. I will tell you right up front for me that I agree with Dave. IULs are horrible. They're not great 401k alternatives. They're not great IRA alternatives. And so those are dangerous. And so if you run into that challenge, I would agree with Dave. But as far as whole life insurance goes, whole life insurance doesn't have the same risk profile as an investment. It is not an investment. It doesn't have the same upside as an investment would have because it's got guarantees. It's got a better floor. You can't lose money. And so when you look at a whole life policy, what you have to be thinking about is what is the role that this money is playing in my life? And now the funny part is Dave will tell you that you need to have an emergency fund, right? And so from there, what I will say is like, when you look at this, I want you to compare this not to your investment alternative, but I want you to compare it to a savings alternative. Now, here's what I want to say is that if you look at this, year one, I'm saying like, let's say you were at 45 years old, you had $60,000 in the bank and you could afford $1,000 a month. That means $72,000 would go in year one, because I would have you take that $60,000 in your bank, in your savings account, and I would put it into this policy. Why would I do that? Because if I'm doing that, now I'm picking up $973,000 in death benefit, okay? So what that can do is whatever term expense you have, if you have a need for $1 million of insurance, well, that's pretty much gets you there. If you have a need for more insurance, well, then you would supplement term insurance above and beyond this, whatever you need. But when you see what I'm about to show you from a long-term perspective, I think what you're gonna see is it becomes a big no-brainer. Now, out of this, you know, why would I put $72,000 in there in the account to get $973,000 death benefit? That just seems like a ripoff. Well, you're not really putting $72,000 in. Yes, you are, but this becomes a banking alternative. Your $65,957 is your net cash value. That is the amount of money you have in your policy with the ability to access that money in case of emergency, in case of opportunity, whatever it is for you. And so your real net cost is, you know, just about $6,000, right? Because you're about, let's just call that $66,000 for round numbers. So you lost liquidity of $6,000, but you paid $973,000. Now, Dave would also probably say, well, $6,000 for $1 million of coverage is a ripoff. To that, you know, you could go get a 10-year term policy much cheaper. To that accord, I would agree. But that's, once again, I said it in the intro, you can't solve long-term problems with short-term thinking. So you are losing a little liquidity, but that is not the actual cost. You have to think from a long-term perspective and realize you're investing in a plan. So let's play this out a little more. Year 2, you put $12,000 in. That policy actually grows by $11,807. Your death benefit goes up from $973 to $991. So you put in $12,000 more, the death benefit actually grew by $18,000 more. So that's leverage, right? You're growing your money. Now, that $12,000, it grew by $11,807. So we're still in the negative, but that's $193. So we can effectively say that year, it was only $193 for $991,000 of coverage, right? That's how that would break. Now, granted, we overpaid the year before, and so our net cash value that we have available, once again, if we're also looking at what we have for our emergency fund, is up to $77,000, right? Now, the next year, we put in $12,000 and the policy's growing by more than we contribute. So on a dollars in, dollars out basis, by year 3, we're already ahead. You can see, once again, the policy grew by about $18,000. Again, the cash value's grown by more than we contributed, right? We put in $96,000, we have $90,000. So now we can look at this and we go, all right, the cost of insurance on average every year, if we averaged it out from a liquidity perspective, we've put in 96, we have 90,000. So it's been about $2,000 a year on average to get this $1 million of coverage. Okay, that's still more expensive than a term policy. Okay, you with me? And so from that perspective, Dave would say, Chris, you're wrong. So I'm going to hop ahead because you understand where I'm going with this, and I want to get to year 6. Now, by year 6, we've contributed $12,000 here again. The policy is growing by $14,473, and we have $131,388. Now we have $1,067,000 of cash there. So what I'm going to do here is I'm going to do a little math. I'm going to go 132,000 minus 131,388. That's $612 divided by 6 years. That's an average of $102 a year after the net cash value for $167,000. Now, when we get through this, remember, we're looking at the net cash value in here is our emergency fund. And so that's an important thing to understand. That's one of the things that Dave will say this is an investment alternative, but no, he'll tell you you need an emergency fund, but we'll also tell you that a whole life policy is a terrible place to store your money. Well, look at the different functions that it's getting. I've basically paid at this point in time $102 a year for $1 million of insurance, which by the way is cheaper than any term policy is going to be on average over that period of time for this kind of coverage, for $1 million of coverage. Now, by the time we get to year 10, you can see we've put in $180,000 of total premium. Now our money available is higher than what we actually contributed, so we're ahead of it. This is going to beat your savings account. Plus we have the death benefit of $1,153,000. Now let's get to the next question, or the next comment, the next rebuttal to what Dave says about this is he says, well, the life insurance company, life insurance is a ripoff. Whole life insurance is a ripoff because the life insurance company keeps your cash and they keep your cash value and they keep your death benefit, or you get the death benefit, but they keep the cash value. That's what he says. So let's run this and say, well, what would happen out of the gate here? Let's say you were to have, we were to start up here at the top and we had $65,000. You started and you had $65,000 and you put that money in a bank account and you had a term policy that was $973,000, just to keep it even, right? So you'd have this $973,000. And let's say for that $973,000, you were paying $400 a year for term insurance. Just at 45 years old, probably be a little more than that. Actually, let's call it $600 a year because for a 45-year-old, I got to remember the age we're talking about here. So let's say $600 for a term policy for $973,000, $600 per year. So over the 10 years, that's $6,000 of expenses, right? And for that term policy that you're going to be dealing with, $6,000 of expenses. Now, you would have $180,000 in a savings account, right? Let's say it was earning 1%, maybe you'd have a little more. But let's just say that the earnings would cover the cost of your term insurance, that $6,000. So maybe $186,000 would be in your savings account, but you had to come out of pocket for the term insurance, and it is what it is. Now, at the end of this time, Dave will say, well, it makes no sense. Why would the insurance company keep your cash value and only pay out the death benefit? Well, if I go $1,153,000, 891, which is where we are right here from a death benefit perspective, and I minus out the $197,000, we're at $956,000, okay? So by year 10, what you can see is that we still have a net $956,000 free and clear. Because as you can see, as the cash value grows, so does the death benefit, right? Now this will continue and it will continue, it will continue. Now to do this fully transparently, you have to add a term rider to this. Now, the next thing that Dave would say is, well, you got $12,000 a year, that's a ripoff, right? Like, what if you can't afford it? The problem is your policy is gonna run into problems, and if you can't afford it, then your policy is gonna lapse, and then the insurance company is gonna screw you over, and you're gonna lose the money there. And so what I wanna show you here is that there is flexibility in here. The minimum premium, or the premium that's scheduled here is the $11,999.96, effectively 12,000 bucks. But you could pay as little as $5,378 in this policy, and you can be without issue, right? Now, and that is extremely important to understand, is that, you know, at this point in time, you don't have to make this $12,000 premium every year. It's absolutely advised. Just like that's why I call it a forced savings plan. But if you had a tough time and you had to cut it in half, you could cut it in half. And furthermore, there are different features that you could do. You could utilize things like a premium offset, meaning, check this out, your minimum payment was just under $6,000. Well, look here, the annual dividend, right, of $6,000 here, once you hit year 9, all you have to do is say, I want to use a premium offset, and I'm going to have my dividend pay for my premium, and you don't have to come out of pocket anymore for this policy. It's there. Now, the other option here is that you could completely pay this policy up at any point in time after year 7, and you never have to come out of pocket again. After year 7, you could have, you know, this $146,000, which you're ahead of your $144,000 in premium. You'd have the life insurance, and you could pay this up, and you'd never have to come out of pocket for any of this premium ever again. It would reduce the death benefit, full transparency, but you would have flexibility. So at the end of the day, you are in more control of this as the policyholder than Dave would have you realize. And instead, he tries to use these scare tactics to get you to think that life insurance is just this devil product that is going to do nothing but hurt you, and he positions it as if it's got no upside for you. It's like the worst financial product on the face of the earth. When, I don't know about you, but if I look at this and I say, okay, I align and resonate with the fact that I need an emergency fund, which if you follow Dave, I would say that you probably resonate with that pretty strongly, right? I would argue you need the greater emergency fund than Dave says, because the average time it takes a person to find a job is 1 month for every $10,000 of income that you earn. So if you're earning $100,000, you need 10 months of emergency fund just to be average, right? Just to be average. And so I would also argue that in times of down market cycles, is the greatest opportunity. So I want to have not just my emergency fund, but I want to have safe, liquid, accessible capital to take advantage of opportunity. And that is where this policy, as it keeps growing, will solve that need for you. Now, what we did here in this policy is we had a 20-year term rider. You can see at the end of 20 years, that term rider drops off. That's why the premium goes down a little bit here. And you can see that the death benefit drops off, because that is where the life insurance company, the term rider drops off. So now this is just a whole life policy from here out with no term rider. Now, Dave will say that, once again, I'm going to go back to this, I'm going to address, Dave will say $652,000. Why would you have the insurance company only pay you that and keep the $444,000 of cash value? Well, once again, if you were to look at this is the next argument. Dave will, you put in $310,000, you have $444,000 of net cash value and $652,000 death benefit. So if something happened to you this year, you're the life insurance company. Well, first of all, if something happened to you this year with Dave's status, if you did a 20-year term, chances are that 20-year term at 65, if you still needed it, would be wicked expensive and you wouldn't do it. The goal would be to be self-insured, which I think is a broke person's mindset way of thinking, because wealthy people understand that if you want to create something of significance, you're probably going to create an estate tax issue. And so the best way to handle estate tax problems is to pass on your net worth to the next generation through the form of life insurance in a tax-free basis, right? Now, moving on to that though, to talk about this. Now, what are the alternatives? I could have kept that $310,000 in a savings account, right? I could have, which by the way, it sounds like a lot of money right now, but $310,000 20 years from now is not going to be as much money as it seems when you count 4% average inflation, which is the average inflation rate we've had since 1971. And when you look at inflation right now, you realize that that number is not that crazy, right? That's the equivalent of about $150,000 in today's money, right? So it's not that outside of the realm of possibility that $310,000 is probably the amount of money you're going to need at that point in time, right? Once again, this is a savings alternative, not an investment alternative. So you got to think about it like that. So the alternative would be if you had your money in a savings account at that point in time, you would pass away. That $310,000 in your savings account would go to your heirs, whoever that would be. Now, if it were your spouse, it'd be no problem. But if it were your kids, there would be a taxable consequence on that $310,000. The reason that we do it through life insurance this way is that $652,000 is leverage. First of all, you have access now. If you want to utilize it for opportunity or for emergency, you have access to that money in case of emergency, and you're going to have access to more money than you would have in a savings account. So it's a form of leverage there. It's a savings account on steroids because it's going to get you a better return on your money than a savings account will. And it gives you the leverage because if something does happen to you, you actually have almost just over $200,000 more of life insurance. And the reason they only pay the $652 over the $444 is because of the fact that if they were to segment them out and say give you $208,000 of life insurance, which is the spread effectively, and then pay the $444, this $444 would have to be taxed the same way that a regular savings account would be. Whereas right now they get this $652, they get to, since they put it all in one payment as a death benefit, it gets to go as a tax-free death benefit. And that is extremely powerful when you break it down. Now, that's a lot, right? And so here's the other thing. And I didn't write this one down and it just hit me. Dave Ramsey says, why would I pay money to borrow my own money? So like, it doesn't make any sense. Why would I pay to access my own cash? And because when you borrow from your whole life policy, what you're doing is you're not really borrowing from your whole life policy, you're borrowing against your whole life policy. So you can see here, like I'm gonna just do this math, right? So I'm gonna go, and this is a way that people need to look because it's really hard to calculate what is the return on this when you're looking at the 444 and then you're saying, okay, well it grew, this is the net increase, but I also contributed premium to it. So let's just see, once this policy is completely paid up at 76 years old, and I could pay this up earlier, but this is when it's just fully paid. I just want to use this example. I could see that this policy grew. You could see the net increase in cash value, this column, and the net cash value there. So you can see I didn't pay any premiums this year. So there's the only growth of this policy is straight from the guarantees and the dividends combined, right? And I got $29,000 of growth. So here we go. We're going to go 29,019 divided by 768,419. So it's a basically 3.77% return on that every single year, guaranteed, tax-free. That's the equivalent of just over a 5%, 5.5% taxable account. And so when you look at that, to me, that's why I call this a savings account on steroids, because those are the benefits that you're getting through this policy the whole time. Now, here's the deal. If I could borrow against this money at 4% and I could access, and my money can grow at that level, of 3.77%. Well, my net cost to borrow, I'm not actually utilizing my own money. I'm utilizing the life insurance company's money. I'm utilizing their money and I'm guaranteeing that loan with the death benefit. And so that is really what this is all about. It's just a form of leverage, right? Now, when I'm paying 3.77 and I'm earning 4, when I'm paying 4 and I'm earning 3.77% on that, I could utilize that for income in retirement. That's another thing. And actually, I'm going to go back to this and check this out. So when we look at this in retirement here, if we look at the annual dividend, this annual dividend can be used as a retirement income supplement at any point in time. So at this age, this dividend could be tax-free income. This is an extra little pension that you could turn on from a completely tax-free basis, right? You don't even have to take loans from it. You could just take it as a dividend distribution. And that is, once again, flexibility, leverage, options that are in your control. Now, let me talk about the number one thing that Dave omits, because I promised you I would. That is the living benefits of whole life insurance. And sadly, people are going to hit retirement and they're going to have a need, for long-term care, disability. The odds are you're going to get sick, you're going to get hospitalized or put in long-term care or put in a home or something of that nature before you retire. Maybe you get diagnosed with cancer. Maybe you get some sort of chronic illness. And unfortunately, most people have these issues and medical debt becomes the greatest burden of people in retirement. It becomes the greatest destructor of retirement plans, medical debt. By following Dave Ramsey's advice and doing term insurance and running out of that and not having the other insurances taken into consideration, or if you follow his advice and you get term insurance and then you get disability insurance and then you get long-term care insurance and you pay for all these different things and you realize, I encourage you, go out and get a quote for long-term care insurance and tell me how much you think it's going to cost. It's going to be catastrophic what it's going to do to your cash flow to pay for this long-term care insurance for any kind of decent coverage. The benefit of whole life insurance is it comes with living benefits. So even if you don't need the death benefit, what you probably want are living benefits, right? You're probably going to want to have insurance while you're in retirement to make sure that you can cover your needs for chronic and critical and terminal illness, right? So check this out. So if we go here, let me go into the point, let's go to where you're 70 years old. And you can see here, if you get terminal illness policy values right here, if you are 70 years old, you could access $670,000 of the death benefit while you're alive, to pay for medical treatments, alternative medical treatments, traditional medical treatments. I happen to be somebody who believes in alternative treatments. I don't, like if I were to get cancer, I wouldn't want to do the traditional chemo and radiation and stuff of that nature. I'd want to have to, and honestly, for me, it's even more important because my values and my beliefs say I want to get alternative treatments that insurance will not pay for, right? But where are you going to get that money? Well, I could have access to $670,000 in this example, completely tax-free, for me to go out and control my own medical directive. Now, even if you are following traditional treatments, you're still gonna have co-pays, you're still gonna have all this stuff that you're gonna come out of pocket for. This can make sure that you have peace of mind around that. Now, at the same time, you can also, on chronic, if you lose 2 out of 6 daily living activities or you become cognitively impaired and you're not able to do it, and not able to live a regular life, you got access to $629,000 while you're alive to cover assisted living, to cover a lot of things in life that you may need. Maybe you need to get a new van for like a wheelchair lift, or you need to get something of that nature. A lot of times these kinds of health issues just strip people of their dignity. They strip people of their ability to take care of themselves. And this is not just life insurance. This is not just death insurance, I should say. This is pure life insurance. And this is life insurance in a way that no term policy can help you. And to be able to compare the actual cost of whole life insurance to what Dave says of buy term and invest the difference. You got to look at the term policy expenses. You got to look at the disability expenses, the long-term care expenses. You got to look at the inefficiency of saving your emergency fund in a savings account. And I think when you break down everything I've shown you here, that yes, maybe the first 5 years, and I'm going to show this one more time, maybe the first 5 years in this policy from a cash value perspective, I'm going to go way up here. Maybe these first 5 years, you're a little bit behind the 8 ball, right? And so you put in 120 and you got 116 available here, right? Almost 117. So you're a little behind the 8 ball, but honestly, at that point in time, it's $3,000 for $1 million of coverage, over a 5-year period. So it's like a couple $100 a year. That's still actually not a bad, not a horrible cost, right? But even though that may be the case, if you want to look at that, especially the first couple years, you're going to be behind the 8 ball, but you're investing in a long-term strategy and you can't solve long-term problems with short-term thinking. And you have these challenges that are going to be, it's almost inevitable you're going to have long-term care or disability needs in retirement. So my question to you is, what are you doing to fulfill that? And what would long-term care insurance cost here? What would disability insurance cost here? And by the way, disability insurance is going to typically stop paying out for you when you're 65 or when you retire, right? So that's an important thing to understand as well. So this is covering you, it's protecting you, it's being a savings alternative. By the time you hit year 6, you have the same amount of money basically that you contributed. So this is anything beyond year 6, this becomes a pure bank account on steroids. You have more liquidity than you contributed. You have a greater death benefit. That death benefit never goes away. The savings growth never goes away. You have access to this money if you want to invest in real estate, if you want to use it for a business, if you want to use it for anything of that nature. And then when you get to the end, you have the leverageability and you have the protection of long-term care. You can see here, supplemental accelerated death benefit plus report, right? So that's what this is showing. You can accelerate the death benefit and take it while you're alive to make sure you're protected, to make sure that you keep your dignity. And this is why I say whole life insurance is one of the most powerful tools. It's a self-completing plan. It's the only financial product in the world that will make sure what you want to happen will happen when you want it to happen, whether you're here to see it or not. The fact that Dave Ramsey twists all these facts to scare you, when everything I just showed you, by the way, is contractually you're in control as the policyholder with a participating mutually held life insurance company and not a stock company. When you have a stock company, the insurance company is typically in control of the performance and the rules of the policy. With a mutually held company, you, the policyholder, are in control, and the life insurance company has to meet the obligations to you, right? And when you know that you're in control of these things, everything I just showed you, and the insurance company has to meet those guarantees for you, I don't see how he can sleep at night when he twists these facts. When you look at dollars in, dollars out, the real benefits, the flexibility being greater than what he says it is, all these things. I guess my call to action now, my question to you is, after seeing all this stuff, argue with me, please. I'm Dave Ramsey, people. If you watch to this point in time and you disagree with me, please in the comment section below, tell me where you think I'm wrong. But lay it out. Don't just call me an idiot. Don't just tell me I'm wrong. Don't just tell me I don't get it. I want you to explain anything I just said that doesn't make sense, that is factually inaccurate to you. Tell me where you think I'm wrong and let's have a conversation about it, because I'm happy to go deeper. I believe in the bottom of my soul that this is something that every single person in the world should have in their life. Period. Period. And I think it's a travesty that as good as Dave Ramsey is at helping people get out of debt, he is decimating people. He is hurting generations of people with the advice that he gives them around whole life insurance. And so people ask me, why do I have to do so much content around this? Because I'm passionate about it. Because I believe that he is hurting people. He is misadvising people. He is telling people that they can go out and have all these expectations of 12% returns and investments and all this stuff, that if he had his license and was advising people, he would lose his license for malpractice. That's how bad his advice is on this regard. And so my advice to people is to don't even take my word on it. Don't take Dave's word on it. Look at the facts that I just shared with you and you tell me what your interpretation of those facts are, because that's a contract that I just showed you. Everything you would just see, you are literally in control of. And so my question is, or my encouragement is, go through that, pause, go back, watch it again, and tell me what you think at that point in time. And we'll go from there, right? So anyway, I hope you found value in that. If you did, subscribe, hit the bell, that way you're notified every time I launch a new video. Share this out, get this out to people. I think this is one of those videos everybody needs to see, everybody needs to understand. Every Dave Ramsey follower, I encourage, if you are a Dave Ramsey follower, get this to other Dave Ramsey followers and open their eyes to it. Or if you think they're smarter than me, have them watch it and try to challenge me. I'm open to it. I just want to have this conversation. Unfortunately, Dave Ramsey likes to run his mouth, but he doesn't want to have like an open conversation where people will expose him for the fact that he's a fraud in this regard. Like, he literally is deceptive and deceitful in this capacity. And that to me is unfortunate. So that's it. Till next video. Have a blessed, inspirational day. Hopefully you found value in this. We'll talk to you soon. See ya.